Hey, Steve Saretsky here. As always, Canadian real estate market update with particular focus on Vancouver. If you're getting sort of value or entertainment out of these videos, all I ask you hit thumbs up and subscribe. Questions, comments, put those below. I think this is an incredibly important video this week. For those of you that have been following my channel for many, many years now, you'll know that I've always been willing to flip bullish or bearish depending on the data. You'll know that, throughout the early days of the pandemic, I was extremely bullish on Canadian housing, despite a lot of people's concerns. That, I believe that the confluence of factors, i.e., central banks providing an enormous amount of forward guidance suggesting that rates would stay low for a very long period of time, that government money printing would also aid in debasing the currency, and that you would see a lift in hard asset prices. That, of course, panned out, right? National home prices increased and inflated at their quickest pace ever on record. We had 2 back-to-back years of record home sales. It was a very good call. And you'll note today that I think that we're at a very pivotal time right now, because I think that housing is set up in the crosshairs for something very, very bad to happen. Because I want to turn your attention to what's happening in the bond market. And I'm going to unpack this video a little bit further, so kind of bear with me. But as we know, Canada has a debt problem. Every financial crisis has always been stemmed through an accumulation of private debt. So that's household debt and corporate debt predominantly. And so if you look at Canada's, say household debt to income, for example, we know that it's off the charts. And so there's always been this kind of debt problem that's kind of lurked in the background. And you can kind of paper over that debt problem so long as you continue to get growth and you continue to get higher house prices, which allow you the ability to refinance that debt. Remember this, higher home prices, house price growth, and lower rates help as well. They allow you to refinance. So anytime that you're in a difficult position, you're over indebted, you got too much credit card debt, what do? You refinance your home, you extend your amortization, and you lower your monthly carrying costs. That allows you to sort of alleviate some of the debt burden. Now, obviously what happens is on higher rates, or if home prices start to stall or go down, you don't have that ability to refinance. So it's just like this safety net that doesn't exist any longer. So what's happening now in the bond market has always been kind of the worst fears. Anytime that anyone's talked about Canada's housing bubble, blowing up and people trying to short it since 2012, it's always been predicated on, well, one day rates are going to go up. And that's what we're seeing right now, is one day rates are going to go up. So what's happening in the bond market over the last 3, 4, 5 weeks in particular is extremely concerning. Because what you have is a situation where the bond market is basically saying, listen, inflation is turning out not to be so transitory. We think central bankers are basically behind the curve. So people are basically selling their bond position, essentially. So the prices of bonds are falling, which means that yields go up. So your Canada 5-year bond is the most important. So that Canada 5-year bond is spiking. It's going up every single day, and that's pushing the price of that bond down. So what that 5-year government bond yield going up is basically what prices Canada's 5-year fixed mortgage. And so what we're seeing today is, if you talk to any big broker, mortgage broker, I talk to a lot of them, I'm extremely plugged in on the ground, it's my job to know this thing, is they're getting calls on a daily, several times a week basis of, hey guys, rates are going up tomorrow. Hey guys, rates are going up tomorrow. And, talking with some experienced brokers in the business, 10, 15, 25 years in the business, like, I've never seen this pace of increase in mortgage rates ever. And so you now have a situation where mortgage rates are climbing to north of 3.5%, and probably by next week or the week after, we could very well see, and probably will see, mortgage rates at 4%. So let's unpack that a little bit, because everyone said, well, Steve, you said, mortgage rates can't go up, they won't go up. Scotiabank and all these big banks are continuing to say, well, the Bank of Canada is going to continue to raise interest rates. The overnight rate of the Bank of Canada will get to 2.5% by the end of the year, from the 0.5 that it's at right now, and it's going to be kumbaya. And I kind of got into this argument with a couple of these economists actually online. And I said, are you guys paying attention? You're sitting in this ivory tower in your leather chair there, but you're actually participating in the housing market and talking to people and seeing what's happening on the ground. Because in my opinion, I don't think, and this is my context when people say, I don't think rates can go up. is I'm saying this because I think something is going to break. The financial system is so highly levered, something is going to break and force the central bank's hand. And that's been my view. It's not that the central bankers wouldn't be stupid enough to actually try and raise rates on a highly levered, not just Canada, but globally, right? We've talked about, like, let's look at the picture of global debt here. I mean, global debt, you see all this debt globally? This has to refinance. This has to roll over the following year or 2 years or 3 years from now. All that debt needs to roll over. That's what I'm talking about. The ability to refinance for households, corporations, again, even government balance sheets, again, they need to roll over. And their only ability to roll over is to have basically, like, essentially lower rates or growth. And so the question is, when you have this highly levered of a global financial system that it's kind of at this end of this long-term debt super cycle, how do you roll this debt over with significantly higher interest rates? That's the basically key argument. And so what I want you to pay attention to is go look at any of these central bank reports that come out, these forecasts. Go look at, Scotia Banks, for example, the one with the aggressive rate hikes. Go look at their forecasts. Why are they not forecasting a rise in unemployment? Why are they not forecasting a fall in home prices? Are they really that naive to think that you're just going to take mortgage rates from 1.5% to 4.5% to 5%, and you're going to take the Bank of Canada or the Federal Reserve's overnight interest rate from 0 to 2 to 2.5% to 3% and have no impact whatsoever on employment and asset prices? Is completely, utterly insanity. And so that's my contention with these people, because these people say, oh, see, the big bank economist told me this, I told you it would happen. It's like, no, watch. Rates are going up right now. The Bank of Canada is going to continue to fall. They'll follow again in April. They'll probably follow again in June, which is their next meeting after that. They're going to continue to go until something breaks. And my point of view is that something is going to break much, much sooner than most people and all these people anticipate, because they don't live in the real world. Let me walk you through a scenario for Canadian housing. Let's keep this extremely simple in terms that everybody can understand. So I'm going to pick up my sheet here and read off to you the scenario. So we have a situation where national home prices at the very start of the pandemic, nationally, the home price index was $580,000. That was the price of your typical home in Canada. Assuming that, mortgage rates at the time fell to 1.5%. So you had all this activity transacting $580,000 typical price at 1.5%. On a assuming you put 20% down and you take a 25-year amortization mortgage, which is extremely typical, your payment would have been $1,855 per month. $1,855 per month. Today, the home price index in Canada is $870,000 because we've had huge inflation in home prices. Home prices are now $870,000. Assuming mortgage rates today are basically at 3.5%, which is what they are today, it's actually probably on the low side, your payment is now $34.75 a month. If you go to 4%, which we'll probably see next week or a couple weeks from now, on your 5-year fixed mortgage, your payment goes to $36.61 a month. So from $18.55 to $36.61. That is basically, for all intents and purposes, a doubling of your mortgage payment. I don't know. You tell me. We just had a 2-year bull market. We're back-to-back years of record home sales, record home price inflation. You've pulled a lot of demand forward, and you're telling me that a doubling in the typical mortgage payment for Canadian home prices is sustainable and you won't see any decline in home prices? That's what this economist is telling me. I got into an argument with him on Twitter. He's telling me that based on our data, based on our research, we believe that there will be no impact to home prices. You'll see a slowdown in sales, but you won't see a decline in home prices. And that's their basis for a 200 basis point increase in the Bank of Canada's overnight rate. I think that is absolutely hilarious. Let's take this a little bit step further. So I didn't do Toronto's numbers, but Vancouver and Toronto are basically like your two largest housing markets in Canada. It's really what everybody focuses on. It's also your two most highly levered housing markets. And so if we take Vancouver now, which is my market, obviously, which I work in day to day as a realtor, that I deal with clients on a everyday basis. During the onset of the pandemic in March of 2020, assuming all property types, right? So detached, condo, townhouse, we mix them all in. We get the benchmark price for Greater Vancouver. So again, a bit of a vague number. Detached prices are obviously going to be more, condo prices maybe a little bit less, but this is a pretty safe number. So the typical cost of a home in Greater Vancouver at the start of the pandemic was $824,000, $560,000. And with rates at 1.5%, your mortgage payment would have been $32.96 per month. $32.96 per month. Well, let's fast forward today. The benchmark price has increased from $824,000 to $1,050,000. $1,050,000 at 3.5% mortgage brings you to $52.46 a month. And if you go to 4% mortgage rates, which again we're probably going to see here, your payment is now $55.27 per month. $55.27. So 33, 43, 53. That's basically a $2,200 increase per month. $2,200 per month. I don't know. Will we see a correction in home prices? Apparently, according to the bank models, no. And so my contention is that yes, you absolutely will see a decline in home prices, assuming that these rates hold. Now, what I want to bring your attention to is understanding how housing markets actually work. Right now, you have a situation where demand is actually falling, and it's fallen fairly considerably. The problem is that we still have extremely low housing inventory. Over the last 2 years, housing inventory has been picked dry. We had so much buyer demand, supply wasn't able to keep up. So we basically have gotten to a situation where inventory is basically at record lows, and now the demand is slowing. Inventory is slowly allowing to build. You can clearly see it. There's just a few more listings coming on, a few less buyers. It's allowing inventory to slowly build. But the reality is that low inventory is basically underpinning the housing market right now. That low inventory is still allowing a lot of houses to go multiple offers because there's still enough buyers out there and still not enough houses to buy, that you're still having basically sustained house prices. Now, what happens is over time is that the buyer demands can continue to peter out, and inventory will slowly continue to build, and eventually it might take 3 months, 4 months, 5 months, 6, 7 months. You'll get to a place where inventory gets to balanced levels and you start to see people starting cutting prices. And that's basically what you have to factor in. So if mortgage rates hold at 4% or go up to 4.5%, they got to hold. If they go to 4 and they come back down to 3.6, then hey, listen, I don't know. But if they get to 4 and they start holding there for 6, 7, 8 months, I'm extremely confident you're going to see a decline in prices to some degree. Again, I can't tell you if it's going to be 10%, 20%, but you have to understand when housing corrects, it's like, again, a cruise ship pulling a U-turn. It doesn't happen overnight, but you're starting to see that. So I'll give you an example. I had some clients that I've been working with for, 6, 7 months minimum, buyers, and basically they were looking for what everybody else was looking for, entry-level house in the suburbs. So they got outbid on 4 or 5 houses, watched the prices go like this. More recently, just this past week, there's a couple houses that we're looking at. Okay, well, they're both priced at $1.3 million. Typically speaking, if this was 4, 5, 6 weeks ago, both of them would have gone, they were getting bid up to about 1.45, so $150K over. You get 7, 8, 9 offers. We were able to secure one for basically you only had to go 60 grand over. So this already, that house would have been 145 4, 5, 6 weeks ago. We were able to get it for 136. Now, is the price declining? Not necessarily, but it's not getting bid up to the levels that they used to get bid up to. And the other house they were looking at basically only got one offer and basically went an asking price, which again was the seller probably, had they sold 4 or 5 weeks ago, probably would have netted at least $100,000 more. So you're already starting to see that. Now, again, one more thing to keep in mind here. This is extremely important. When people take on mortgages, so when they go to the bank to get a mortgage pre-approved, you get typically a 90-day rate hold. You get 90-day rate hold. So a lot of people are still holding rates today on 5-year fixed mortgages at 2.9, 3, 3.1, 3.2. A lot of people are still holding lower mortgage rates. Once those mortgage holds start to expire, that's when they become subject to higher mortgages. So someone that locked in a 3% mortgage 2 months ago, they have about a month to buy a property and close on it. They got to buy a property, close on it in 4 weeks, or guess what? They're getting subject to the new mortgage rate, the market rate, which again is going to be 3.6, 3.7, 4% in a couple weeks. And so that's when you start to see. So this all takes time to filter through into housing. Housing is extremely slow moving. You're still seeing things going multiple offers. The housing market still looks pretty great. But the underlying dynamics, assuming the levels of debt that we have, assuming where prices are today, this is my contention on pushing back on this notion of like higher rates and everything's going to be sustained and like there's not going to be a recession, like the Bank of Canada. Because what's going to happen is you're going to start seeing home sales pull back. You'll start to see prices decline. Again, that could take easy 6-7 months. Then the Bank of Canada will be coming out and they'll be talking about financial stability. Because once you start having declining home prices, that becomes a financial and systemic risk. And you guys might laugh and say, oh, well, who cares? Prices drop 10%. That only brings you back to, December pricing. It doesn't matter. It's not how the banking, in a highly levered economy with a highly levered banking system, it doesn't matter. The banks don't like to see 10, 15% declines on their asset book. And in a highly levered economy, which is, again, it's depending on refinancing, I would just take you to this chart here. People that bought in 2017 and are now renewing, they're going to see their costs increase as they go to renew their mortgage costs. And so this is all going to start to chip away at consumption. And as we know, inflation is already high. Inflation is already going to be a drag on consumption. We already have governments. The Quebec government and the BC government, which where I'm here, is now the BC government's cutting a check to every single person that drives a car, even if you drive an electric car. They're cutting a check for $110 to offset rising gas prices. So they're already starting to mail checks to people, trying to sort of keep consumption elevated or keep it from falling further. So now you're going to tack on not only the inability to basically refinance here, probably moving forward, but you're going to basically put a harpoon through the nation's biggest driver of economic activity, aka housing. You're going to stick a harpoon in that thing and tell me that there's not going to be any disruption to unemployment, to the job market, and to house prices is beyond laughable. And I honestly feel bad for people that still pay attention. Again, I'm not saying that rates can't and won't go up. You guys know my view. I said 3 to 4 hikes before the Bank of Canada gets stopped out. The bond market is going to do the Bank of Canada's job. Inflation and the oil market are doing the Bank of Canada's job. Financial conditions are tightening drastically. And so my view is, let's watch this. We want to watch this. Like I said, the mortgage rates have to get to 4. They got to hold there. They got to hold, because if they don't hold, then all bets are off. But they got to hold. I think it's a wise time to be accumulating and building cash. I think that if these guys are going to drive rates up, and again, I don't think they're that smart. I mean, the governments are handing out checks here to fight inflation. I mean, don't think they won't make a policy error by raising rates too far. But if they do, there are going to be opportunities. So that's what I'm watching. I think that people are naive to think that the housing market can actually withstand these types of mortgage rates at these levels. But that's what the bank economists think. And so let's watch. That's my view on the housing market. I think it's extremely important to watch here moving forward. And as always, hope that helped. We'll see you next week.